Now we are starting a very important lesson, risk management. Risk management means protecting your trading account before chasing profit. Many beginner traders focus only on how much money they can make, but professional traders focus first on how much money they can lose. That is the difference. Before taking any trade, we need to know 4 things. The first one is entry. Entry means where we plan to get into the trade. We do not want to enter randomly. We want a clear reason for entering. The second one is stop loss. Stop loss means where we are wrong. This is a level where we accept that the trade idea did not work. The third one is target. Target means where we plan to take profit if the trade moves in our favor. The fourth one is size. Size means how many shares or contracts we're going to trade. Position size should be based on risk, not confidence. The main message on this slide is very important. Survival comes first. Profit comes second. If we protect our account, we can keep trading and keep learning. But if we risk too much, 1 or 2 bad trades can damage the account badly. So before every trade, remember this. Do not ask only, how much can I make? First ask, how much can I lose and can I handle that loss? That is how professional traders think.
Now, let's talk about the lesson goal for risk management. By the end of this lesson, students should understand how to protect capital and control every trade before entering. This is very important because risk management is the most important trading skill. A trader can have a good strategy, good entries, and good indicators, but still lose money if risk is not controlled. The first goal is to understand why risk management matters. Risk management protects the trading account. It helps us stay in the game long enough to learn, improve, and grow. The second goal is to learn how to plan the entry, stop loss, target, and position size before every trade. Before entering, we should already know where we are getting in, where we are wrong, where we want to take profit, and how much we are risking. The third goal is to use daily and weekly limits. These limits help protect us from emotional decisions. If a trader has a bad day, the limit tells them when to stop instead of revenge trading. The fourth goal is to understand how winners, losers, and risk to reward work together. You do not need to win every trade to be profitable. What matters is how much you make when you win compared to how much you lose when you are wrong. The main lesson is this. A trader can have a good strategy and still lose money if risk is not controlled. Professional traders do not first ask, how much can I make? They first ask, how much can I lose? That mindset is what protects the account and builds discipline. Now, let's define risk management. Risk management is a set of rules that protects your trading account from large losses. This is very important because markets are uncertain. No trader wins every trade. Even professional traders take losing trades. The difference is that professional traders control the size of the loss. There are 3 main parts on this slide. The first one is dollar risk. Dollar risk means knowing exactly how much money you can lose on the trade before you enter. For example, before taking a trade, we should know whether we are risking $50, $100, or $500. The second part is the trade plan. The trade plan includes the entry, stop loss, and target. Before entering, we should already know where we are getting in, where we are wrong, and where we plan to take profit. The third part is discipline. Discipline means knowing when to stop trading. This includes stopping after a daily loss limit, avoiding revenge trading, and not increasing position size because of emotion. The key point is this. Risk rules protect traders from large losses, revenge trading, and oversized positions. A good risk plan keeps you in the game long enough to improve. If we protect our account, we can keep learning. But if we take losses that are too large, it becomes much harder to recover. So remember, risk management is not about avoiding every loss. Risk management is about making sure one loss does not destroy your account.
Now let's talk about entry, stop loss, and target. Every trade should be planned before the order is placed. This means we should not enter first and then decide what to do later. Before we enter, we should already know 3 things. First is the entry. The entry is where we get into the trade. In this example, the entry is $100. Second is the stop loss. The stop loss is where we exit if the trade is wrong. In this example, the stop loss is $98. That means if we buy at $100 and the price drops to $98, we exit the trade. We are risking $2 per share. Third is a target. The target is where we plan to take profit. In this example, the target is $104. That means if we buy at $100 and price moves to $104, we make $4 per share. Now, let's look at the risk to reward. We are risking $2 to try to make $4. That gives us a 1 to 2 risk to reward ratio. This is important because we do not need to win every trade if our winners are bigger than our losers. The teaching point is very important. Never enter a trade without knowing where you are wrong. If you do not know where your stop loss is, you do not know your risk. And if you do not know your risk, you do not have a complete trading plan. A professional trader plans the entry, stop loss, and target before taking the trade. Now let's talk about stop loss. A stop loss protects the trading account when the trade idea is wrong. This is very important because every trader will have losing trades. The goal is not to avoid every loss. The goal is to make sure the loss is controlled. A stop loss should be placed where the trade idea becomes invalid. Let's look at some common stop types. The first one is below support, for a long trade. If we are buying near support, the stop loss may go below that support level. If price breaks below support, buyers may no longer be defending that area. The second one is above resistance. For a short trade, if we are selling near resistance, the stop loss may go above that resistance level. If price breaks above resistance, sellers may no longer be in control. The third one is using the candle high or candle low. This uses recent price action. For example, a long trade may use the recent candle low as the stop area. If price breaks that low, the short-term structure may be failing. The fourth one is using VWAP or moving average. These are technical levels. If price is using VWAP or moving average as support, a break below that level may show the trade is weakening. The fifth one is an ATR-based stop. ATR uses volatility to give the trade enough room. If the market is moving a lot, the stop may need to be wider. If the market is calm, the stop may be tighter. The most important rule is this: do not move the stop farther away because you hope price comes back. That is how small planned losses can become large uncontrolled losses. A small planned loss is normal. A large uncontrolled loss is dangerous. So before entering a trade, always ask, where's my stop loss? Where's my trade idea wrong? How much money am I risking? A professional trader accepts small losses because protecting the account comes first. Now let's talk about position sizing. Position sizing decides how many shares or contract we should trade. This is one of the most important parts of risk management because the same trade setup can be safe or dangerous depending on size. Let's look at the example on this slide. The first part is account risk. In this example, the trader is willing to risk a maximum of $100 on the trade. That means if the trade is wrong and the stop loss is hit, the trader does not want to lose more than $100. The second part is risk per share. The entry price is $50. The stop loss is $48. So the risk per share is $2. That means for every share the trader buys, they are risking $2. Now we calculate the position size. The formula is position size equals account risk divided by risk per share. So in this example, $100 divided by $2 equals 50 shares. That means a trader can buy 50 shares and still keep the total risk around $100. This is very important because the trader is not guessing. The trader is using a rule. If the stop loss is farther away, the position size should be smaller. If the stop loss is closer, the position size may be larger. The main lesson is this: position size should be based on risk, not emotions. Do not take a bigger position just because you feel confident. Confidence does not protect your account. Risk management protects your account. Now let's talk about risk per trade. Risk per trade means how much of your account you are willing to lose on one trade if the trade does not work. Professional traders do not risk a large amount on one trade. They risk a small, controlled amount. On this slide, we can see 3 common risk levels. The first is 0.5%. This is conservative risk. It is safer and helps protect the account, especially for beginners or during difficult market conditions. The second is 1%. This is a common risk level. Many traders use 1% because it keeps losses controlled while still allowing the account to grow over time. The third is 2%. This is more aggressive risk. It can grow the account faster if the trader is winning, but it can also damage the account faster during a losing streak. Now, let's look at the example. If a trader has a $10,000 account, then risking 1% means the maximum loss on one trade is $100. Risking 2% means a maximum loss on one trade is $200. This is important because we should know our maximum loss before entering the trade. The main lesson is this: small controlled losses keep you in the game. One large loss can destroy weeks or months of progress. Also, risk should be reduced during losing streaks or volatile markets. If the market is very difficult, or if you're not trading well, it is better to lower the risk and protect the account. A professional trader does not ask, "How big can I trade?" A professional trader asks, "How much can I safely risk?" That mindset is what keeps traders disciplined and consistent. Now, let's talk about the risk-to-reward ratio. Risk-to-reward tells us how much we are willing to risk compared to how much we are trying to make. Good trading is not only about being right. Good trading is about making sure your winning trades are bigger than your losing trades. On this slide, we have 3 examples. The first example is 1:1. This means you are risking $100 to try to make $100. The second example is 1:2. This means you are risking $100 to try to make $200. The third example is 1:3. This means you are risking $100 to try to make $300. Now, let's look at the example in the middle. The trader wins 4 trades and makes $200 on each winning trade. That equals $800 in profit. The trader loses 6 trades and loses $100 on each losing trade. That equals $600 in losses. So even though the trader lost more trades than they won, the final result is still a $200 net profit. This is very important. A trader can lose more trades than they win and still be profitable if the winners are larger than the losers. That is why risk to reward matters so much. Many beginners focus only on win rate. They want to be right all the time. But professional traders focus on the full math. They ask, how much am I risking? How much can I make? Is the reward worth the risk? Can this strategy still work even with losing trades? The main lesson is this: you do not need to win every trade. You need to control losses and make sure your winning trades are large enough to cover your losing trades. Now let's talk about daily and weekly loss limits. Loss limits protect traders from emotional trading and bad market conditions. Every trader has losing days. That is normal. But the danger comes when a trader keeps trading after they are already frustrated, angry, or trying to make the money back. That is called revenge trading. A daily loss limit tells us the maximum amount we are allowed to lose in one day. For example, if the daily loss limit is $300, then once that loss is reached, trading stops for the day. The trader does not keep forcing trades. The trader stops, reviews, and comes back tomorrow with a clear mind. A weekly loss limit works the same way, but for the full week. For example, if the weekly loss limit is $1,000, then once that limit is reached, the trader should stop, review what went wrong, reduce position size, or paper trade. This is important because the worst trades often happen after frustration, anger, or revenge trading. When trading is not working, the answer is not to trade bigger. The answer is to slow down and review. A professional trader knows when to stop. The main lesson is this: loss limits protect your account and your mindset. They stop one bad day from becoming a terrible week, and they stop one bad week from damaging the trading account badly. So before you start trading, always know your daily loss limit and your weekly loss limit. Now let's talk about no trade rules. Sometimes the best trade is no trade. This is very important because many traders think they must always be in the market. But professional traders know that waiting is part of trading. A no-trade rule tells us when to stay out of the market, even if we see a possible setup. The first rule is, do not trade during major news unless it is planned. Major news can move the market very fast. Price can spike up and down, spreads can widen, and stop losses can get hit quickly. The second rule is do not trade after hitting the daily loss limit. Once the daily loss limit is reached, trading should stop. This protects the account from revenge trading. The third rule is do not chase after missing the entry. If the trade already moved without us, we should not jump in late. Chasing usually gives poor risk to reward. The fourth rule is do not trade in choppy conditions. Choppy markets can create false signals. Price may move up, then down, then up again, without clear direction. The fifth rule is do not trade without a stop loss. A stop loss protects the account when the trade idea is wrong. Trading without a stop can turn one bad trade into a large loss. The sixth rule is do not trade oversized positions. Position size should be based on risk, not confidence or emotion. The teaching point is very important. No trade rules are not weakness. They are discipline. A professional trader waits for the right setup, not any setup. The main lesson is this. Good traders do not need to trade all the time. They wait for high-quality trades and protect their account when conditions are not good. Now let's talk about managing winning and losing trades. Risk management does not stop after we enter the trade. Many traders think the hard part is finding the entry, but managing the trade after entry is just as important. First, let's look at winning trades. When a trade is working, we still need a plan. One option is to take partial profit. This means we close part of the position and lock in some gains. Another option is to move the stop to break even. This means if price comes back, we exit around our entry price and protect the account from a loss. We can also trail the stop. This means we move the stop higher as price moves higher in a long trade, or move the stop lower as price moves lower in a short trade. Another rule is to exit at resistance. If price reaches a major resistance level, it may be a good place to take profit. We may also exit if momentum fades. If the candles get weak, volume slows down, or the move loses strength, it may be time to protect the profit. Now let's look at losing trades. The first rule is to accept small losses. A small loss is normal in trading. Every trader has losing trades. The next rule is to follow the stop. If the stop loss is hit, we exit. We do not argue with the market. We should not average down emotionally. Adding more to a losing trade without a clear rule can make the loss much bigger. We also should not move the stop farther away. Moving the stop farther away usually means we are hoping instead of following the plan. And finally, we do not revenge trade. After a loss, we do not jump into another trade just to make the money back. The teaching point is this. A small loss is normal, but a small loss becoming a huge loss is a risk management failure. A professional trader manages both winning trades and losing trades with rules, not emotions. Now, let's talk about common risk management mistakes. Most trading damage comes from breaking simple risk rules. Many traders do not lose because they had one bad trade. They lose because they make one mistake bigger than it should be. The first mistake is oversizing. Oversizing means trading too many shares or contracts. When the position is too large, every small move feels stressful. The trader becomes emotional because the loss is too big for their account. That can lead to panic decisions. The second mistake is moving stops. This happens when a trader places a stop loss, but then moves it farther away after the trade goes against them. They may think, let me get more room, or maybe price will come back. But if the stop is moved without a rule, the trader is making the loss bigger after entry. That is dangerous. The third mistake is revenge trading. Revenge trading happens when a trader loses money and then tries to win it back emotionally. Instead of following the strategy, they start taking random trades, bigger trades, or lower quality trades. This can turn one small loss into a very bad day. The key lesson is this. Holding and hoping is not a plan. Averaging down without rules can turn one mistake into a disaster. Changing risk after every trade usually means emotions are in control. A professional trader accepts that losses are part of trading. They keep losses small, follow the stop, and never let one emotional decision damage the account. Now, let's go through the risk management checklist. This checklist should be used before every trade. The purpose is to slow us down and make sure we're not entering emotionally. The first question is, what is my entry? We need to know exactly where we are getting into the trade. The second question is, what is my stop loss? Before entering, we must know where we are wrong. The third question is, what is my target? We need to know where we plan to take profit if the trade works. The fourth question is, how much money am I risking? This is very important. We should know the dollar risk before the trade starts. The fifth question is, what is my position size? Position size should be based on risk, not confidence. The sixth question is the risk to reward worth it? If the possible reward is too small compared to the risk, the trade may not be worth taking. Now, we also need to check the trading environment. Am I trading during news? Major news can create fast and unpredictable moves. Am I calm or emotional? If we are angry, frustrated, scared, or try to win money back, we should not trade. Is this trade part of my plan? If the trade does not match the strategy, we should stay out. What will make me exit? We need to know the exit rules before entering. Have I hit my daily loss limit? If the daily loss limit is reached, trading should stop. Is this the right market condition? Some strategies work in trending markets, and some fail in choppy markets. The main lesson is this: a checklist protects us from emotional trading. A professional trader does not enter because the market is moving fast. A professional trader enters only when the trade passes a checklist. Now, let's finish with a simple teaching summary. Risk management is the bridge between strategy and survival. A trading strategy may help us find entries, but risk management helps us protect the account. There are 4 important words on this slide. The first word is plan. Every trade needs a plan. Before entering, we should know the entry, the stop loss, and the target. The second word is control. We must control risk and position size. We should never trade too big just because we feel confident. The third word is protect. We protect the account by using daily and weekly loss limits. These limits help us stop before emotions take over. The fourth word is review. Every trade is a lesson. Win or lose, we should review the trade and learn from it. Now remember the key points. Every trade needs an entry, stop loss, target, and position size. Risk to reward matters more than being right every time. No trade rules are just as important as entry rules. A beginner focuses on profit, but a professional focuses first on protection. The closing line is very important. Protect the account first. The money comes from staying disciplined long enough to let good setups work. That is the mindset of a professional trader.